Now we will begin our first panel discussion on successful global FinTech updates. It's moderated by Mr. Brett King. Let me call on the participants. Mr. Khaled El-Gabali, Division President, MENA MasterCard.
Thank you.
Hello, Khaled, good to see you. Nadeem Hussein, founder, Planet N Group and Telenor Microfinance Bank.
Nadeem, please. So you just sit on.
Hans van der Velde, Vice President, Global Channels, EMEA Corporate and Investment Bank, JP Morgan. And Umair Hamid, Advisory Partner, KPMG Middle East.
Welcome, gentlemen. So we're going to be talking about successful global fintechs and some updates on that. But let me just first ask, what is a fintech? How would you guys define a fintech? Who would like to? Oh, actually, no. Before we start that, Khaled, to frame this, obviously, from a regional perspective, why don't we get some thoughts from you for a few minutes, from MasterCard's perspective as a player across, so you can sort of frame the discussion for us today. Sorry.
Sure, Brett. Thanks very much. I think there are three. I mean, I'm sure there are more, but there are three key trends that have really impacted, I think, the crossroads, or maybe the springboard, let's say, that we're at today. I mean, some of them are macro, some of them are micro. I think the first one in my mind is a realization over the last few years that digitizing payments, technology, and actually getting into that space is not a luxury anymore. Governments have realized cost of cash is inefficient, reach 1.5% of GDP, etc. Does not provide the same level of transparency, does not drive the same kind of FDIs that otherwise would be driven if those flows were digitized. So that's one at the macro level. I think the second one is there is an evolving, maybe quickly evolving, change in consumer behavior. Consumers are consuming and doing commerce in a very different fashion. Now, whether it's driven by millennials or Gen Ys, etc., in my mind, it's driven by access to data, and you touched on it. It's access to data through this thing that people carry around now. Consumers want a choice. They've always wanted a choice, but now they know what the choices are that are available out there, and they want to exercise that choice. So whether they want to open a bank account in a branch or somewhere else, they want to be able to make that decision for themselves, and that is quickly changing. One of the things we know for a fact from, again, looking at trends is the change in commerce, and I'm not talking about e-commerce, I'm talking commerce generally, over the next 5 years, is probably going to be as much or more than what we've seen over the last 50 years. And that's also in keeping in tandem with the evolution that we're seeing in technology. And I think that brings me to the third and last one, which is what is possible now. I mean, if you look at 2015, we had 15 billion connected devices. In 2025, in 10 years, that's going to become over 65 billion. So what is becoming possible now in terms of you transacting, buying, living, doing stuff through the connected device, whether that's a fridge or whether that's an iPad or something else, is just very, very different. So that ecosystem, the technology ecosystem, and what is possible is very different. Now, why am I giving those three pillars introduction? Because fintechs, and I think that brings me to the subject, because in our view, the most effective driver, which really underpins these kind of three pillars, really to take it to the next level, is what fintechs are doing, whether that's in the speed of their innovation, in their capabilities, in their unfettered kind of sometimes uncontrolled, which is a good thing when you're innovating, approach to finding solutions and actually living your first principle thinking very effectively. That's really what's driving, a lot of it what's driving this change. And we'll come to, I'm sure, to it in subsequent discussions in terms of how we can collaborate and partner. The last point, I'll mention this before handing back, is large organizations, and I think you referred to that, whether they're in the FI space, financial institution space, or otherwise, first principle thinking may not come naturally. It's more incremental thinking, which is fine. But I think what a lot of organizations are doing now, and certainly we are aspiring to do that effectively, is to say, how can we disrupt our own model? How can we create an alternative to what we have done for the last 30, 40 years as MasterCards and payments? So the pioneering work that has been done on rolling out QR code payments, which is now reinventing acceptance in many of the markets that we operate in, whether those are in large populous scale markets like Pakistan or the whole of sub-Saharan Africa, it is just saying, well, if we had to do payments now, how would we do it? Would we do it through your traditional $400 point of sale? Would we do it through even the incremental MPOS, mobile point of sale? Or would we come up with a totally different model which can perhaps disrupt the way that things have been doing? So trying to live as much as possible this first principle thinking you're referring to, so trying to operate as a fintech, if one may say that. Yeah. But I'll hand back to you so we can carry on.
That's very interesting. Thank you for those introductory comments. So maybe I might start with Nadeem. Nadeem, how has fintech changed, markets like Pakistan, for example?
Well, thank you, Brett. Pakistan's change in financial inclusion has actually largely been through fintechs, and it's been very recent. And the whole concept that the fintechs have worked on is what I call using other people's railroads. Because the fintech, while it's nimble and it's smart, doesn't have a capital and the resource or the brand that an established bank has. So, just give an example, 11 years ago I created a small company which went on to become the second largest payment provider in the world. And the basis was that instead of using traditional bank branches or ATMs, we would use what in developing countries is most common is agents of telephone companies which are typically used for buying airtime, because in developing countries 95 to 99% of subscriptions are prepaid. So if you can convert that agent where you could initially open an account, later on actually you don't need to go to the agent, make a deposit, make a withdrawal, do a transfer, pay a utility bill, suddenly you've created a branch of a bank physically to start with, which is like 10, in Pakistan, there were 100,000 agents versus 12,700 bank physical branches. The agents don't go and play golf on Saturday. They don't shut down at 5 p.m. They're open Saturday, Sunday. So that fact that we were able to create this network allowed us to move domestic remittance, which was on a Hawala Hundi basis, to this Easy Paisa network. And it became, as I said, we moved 6% of Pakistan's GDP in a single year on domestic remittances. So what I find is that fintechs will be enabled if and only if the central bank creates the regulatory environment for them to operate. So the key for financial inclusion in my mind, while technology is taking place, you can talk about Internet of Things, you can talk about the phone density, unless the regulations support what you're trying to achieve in financial inclusion, fintechs won't survive. If your capital barrier is too high, or if your KYC requirement is not tiered, you won't get the desired results. So while technology is taking place, regulation has to go hand in hand, and if the central bank has the vision to perceive what's going to happen and how to contain that risk, because obviously we're living in the world of OFAC and all kind of regulatory requirements for even a $1 transaction. But there are ways and means now to do this KYC on an electronic basis without the customer physically having to be present. There are ways of opening a 1-minute bank account, which is tiered as far as risk is concerned. And that's the start of financial inclusion.
Yes, absolutely. Now, I want to remind you all that if you have the app for the event, the Terrapin Events app. You can participate in this panel discussion. You can give us some questions you would like to direct the panelists. I can receive it here on my phone and direct that to the panelists also. Maybe, Umair, let me ask you this. You know, dealing in the advisory capacity in the region, what are the types of issues you start to see incumbents concerned about now, given the growth of fintechs globally?
Sure. Thank you for that. So I think in my view, if you look at the banking value chain, over the years it's been decoupling, right? So historically banks would do everything, you know, right from marketing, sales to servicing, selling, etc. And you know, with the introduction of outsourcing, ATMs, different things, that decoupling became more and more evident. And I think what we're now moving towards is where you have these fintech companies that are actually providing solutions for specific parts of the value chain. And I think our clients are really worried that one day you're going to have different blocks of fintechs that you could assemble and essentially have a modular.
Rebundling.
Exactly. So
Yes.
you've actually bundled a bank together without even realizing it. I don't think you're going to call it a bank, but it will still provide you banking as you want it. And I think that's a big challenge that a lot of institutions are grappling with, is how do you kind of cover your bases so that you're not caught short when that happens?
Well, I think that's already happening in China, for example. WeChat is a very good example of that. Hans, from an infrastructure perspective, we've been very used to the fact that on the wholesale level, whether it's capital markets or whether it's bank-to-bank payments and so forth, this has been very much the domain of you know, bank-owned networks and technologies that we built up over many decades. But now we're starting to see emergence of things like blockchain for trade finance and so forth. So how do you think fintech is going to change the back end, the wholesale side of banking?
I think we partner with FinTech. We set up an in-residence program to really figure out, like, we need to, and I think similar along the lines of MasterCard, that we need to partner with FinTech companies. We have an in-house program, an in-residence, where it's a bit like a fast track, where we can get FinTechs in very quickly. And we give them access to our senior leaders and also our senior technology people, so they can get their concept proven very quickly. And if it works, we can invest in them. And it's more like, and it's still a partnership approach. They get to keep their IP, they get to become successful, so it's not like that we own them and do stuff, control them. So I think that's how we see it really from an infrastructure point of view, where, like you say, in the past, we'd be very inward-looking, build on our own, build in a vacuum. I think that's all changing very rapidly.
So what's the benefit for JP Morgan not building it on their own? Why have you...
I think partnering with the wider world, we have a center of excellence for blockchain and other companies. I think if you want to stay ahead or stay on top, you need to get new ideas and new ways of thinking. And I think there's a big culture shift at the company as well, at the firm, where we really, Jamie jokes about us being a tech company and do banking as a hobby. He's really trying to drive the ethos where, you think more like a tech company. So we bring in fintech companies to help us. We hire from fintech companies to run programs like the e-residency and really figure out that, if we move along together, especially with things like blockchain, you need a partnership approach to get the network to work, to make it secure and to think of things like that. So it's a much more collaborative approach. It's difficult to do, but I think with things like Ethereum and our Quorum blockchain and the alliances around that, I think we're starting to move in the right direction. It's not easy, but I think we're making good progress.
Very cool. So it's interesting. How many of you, I'm asking the incumbent banks now, how many of you guys have teams that look at cooperation with fintechs? We have a few. So this is becoming more and more common on a global basis, we find. Let's go back to payments for a second, and I'll go back to Khaled from MasterCard. We've suddenly seen, almost overnight it appears, an explosion of mobile payments in China, and this has produced this shift towards cashless economy in China, far faster than we actually anticipated in China. When you go into the cities like Beijing, Guangzhou, Shenzhen, Shanghai, and so forth now, everyone is now using these mobile payment schemas. And you guys have done a lot of research into this cashless arena. So how quickly do you think that it's going to impact this region in terms of cashless and behaviour things like what we see in the Middle East, like the post-dated check behaviours, as we start to shift to these real-time payments systems?
Sure. I think it again goes back to the evolution that we've seen from organizations, institutions thinking that it's a zero-sum game and they have to compete, rather than what we're seeing now, where the future is really about collaboration, and some people would call it co-opetition, competition, but also collaboration at the same time. And this, for us, again, from our experience in over 150 countries and seeing what's happening in China, seeing what's happening in Africa, seeing what's happening in this part of the world, there's some points that are worthy of note. One is, when we look at the mobile as a full factor penetration compared to, let's say, your traditional bank account, on one end of the spectrum, on the mobile side, you'll see rates of penetration ranging between maybe a low of 70-80% to a high of 220%, right? So that's already there, and it's there to stay, and it's only going to become more proliferated. On the other end of the spectrum, you see rates of banking, which is why there's a drive to, behind financial inclusion to support that, of ranging between anywhere between 10 and 15% to a high of 30% in terms of banking account penetration. So I think there's a play here in terms of collaboration to actually include people. I mean, we've gone on the record and saying we want to include, out of the 2 billion unincluded kind of consumers around the world, which is a significant portion of the world population, we've made a commitment to include about 500 million by 2020. But going back to your question, now, why has it been successful in China? Why is it being successful in a Kenya environment? Why is it
Pakistan,
actually kind of really growing by leaps and bounds? I think in our minds, one thing is that it is really built on an already established consumer habit. It has really been driven by customer centricity. Now, what do I mean by that? Consumers are already on social networking sites, chat sites. Integrating payments and transfers on that, then it's just a natural thing. You've not tried to rock the boat and saying, oh, hold on, let me just show you something which is totally different from what your current behavior is now, and then educate you to get on it and use it. Now we're saying, what are you doing now? What is your lifestyle? What do you do when you wake up every morning, and can we integrate transfers and payments into that? So that's the first driver of quick adoption and success.
Behavior.
Behavior, absolutely. The second, and I'll stop here, the second driver in our minds is, it's really been very use case specific and in a very relevant way. And why is that important to say use case is important? Because when you're trying to shift behavior, and it's a good thing to shift behavior in this case from cash, as we said, to digitized payments, when you're trying to shift behavior, you shouldn't really come up with an alternative or an option that's as good as.
Right.
But hopefully come up with an alternative that is better than.
Faster, cheaper,
Correct.
easier. Yeah.
Now, we always say, use your cards, use your mall, because it's as good as cash. That's probably the wrong approach.
Right.
I should tell you, you should change behavior because I've got something for you that's better than what you do today, right? Better, sometimes is looked as cost. Yeah, it can be. But better, for example, in what we've done in transport, smart cities, urban mobility, with the London Underground, with New York, with the buses in Colombia, is not about cost, it's about faster. So when you have a use case that requires very fast throughput of travelers and commuters, contactless enablement of a mobile payment form factor that can have a funding mechanism as cash or debit or credit or prepaid, doesn't really matter, right? Then becomes paramount, and it shifts behavior. So those are the two key drivers. It's happening in this part as we speak. Now we're seeing it.
I think you're right. I think if you're going to look at fintechs globally, the one thing they all have in common, whether it's blockchain or mobile payments or digital banks, is they're all trying to eliminate friction. The problem we have in banking is we're very attached to friction. In fact, we have a special word for it in banking. We call it risk mitigation. Am I right, Hans? So it's sort of burned into our ecosystems, but that is starting to change. So let me open it up to the panel here. Let me ask you a question. When you look at the fintech initiatives that are happening globally right now, what excites you? What do you think is going to be most transformational in the future?
Brent,
start
I'd
with
just
you.
like to add on to what Khalid said a bit earlier,
Sure.
because payments is what seems to be is the backbone right now of the fintech play. It's going to be followed, in my view, by nano credits, followed, subsequently by potential saving. But right now, payments is driving it. So what's going to change, people's behavior where we're a cash society? In developing countries, typically, a very large percentage of money is in circulation, printed but not in any bank's account, because there aren't that many bank accounts. So the first thing you need really to challenge is, what does it take to open a bank account? Does it take a day? Does it require paperwork, or is it a 1-minute bank account? What can we do to identify the individual's identity in a manner that satisfies regulation and technology that exists to make that happen? So the first challenge is, how do you get a mobile wallet open? Can you do it remotely in a minute through an SMS or not? Because if you're going to require the individual to come to a bank branch during working hours and you want 50 million bank accounts, just work out. It's not going to happen. The second thing is, once you've got those accounts, and let's say in Pakistan we've got those accounts, what's the use case? Because if the use case is just doing a top-up, you really haven't done any fintech innovation. If the use case is paying your utility bill, you've done maybe 5% of fintech innovation. What's the use case? Unless you can do what I call the 6 orange purchase, that means you can buy 6 oranges from a hawker digitally without paying an MDR, you don't have a use case. And masses are not going to move onto using a mobile account. And when there's no balance in the mobile account, eventually it's a losing proposition. So you've got to look at the entire ecosystem to make payments work. And I think just get the first thing, the account going, and then the use case going, and the merchant network going. And that's not limited to e-commerce. I'm talking about physical payments, digital payments for small transactions. Coming back to the question you asked, I'm most excited about artificial intelligence. I think the application in the financial world, in the banking world, or practically any industry is huge. In fact, I'm so excited that we're just about to create a company in Egypt for artificial intelligence with our local partners, because I think the market is so big over here and the need is so much. The point you made earlier, you walk into a grocery store, you're going to make a payment, let's say it's a frictionless payment, tap and pay, whatever it is, no card, but you're out of money. If you're going to give that individual instant credit, one of the only ways you're going to be able to do that is if you have data in that individual, and that data resides, of all places, on his or her smartphone. So if you have an algorithm that allows you to access that data on the spot, within a minute, theoretically, you would be able to give the small amount of nano credit you're looking for immediately. And that's very doable, and it's happening right now. You'll be able to forecast loan defaults. You're able to forecast churn patterns. You're able to forecast how your customer's account is going to behave. All that is actually driven through machine learning, artificial intelligence, and those algorithms are available and custom made. It's up to the banks to embrace those, try a proof of concept, and see how they work. So that's, for me, is the most exciting thing, because I think the consequence of using AI is going to be a changed customer journey, where it's taking you a month to apply for a credit card, you're going to get an approval within 5 minutes.
It's going to give us new tools.
Yeah, it's going to give you cash in your hand under 10 minutes. And when we are talking about fintech or technology, my view is, if it doesn't change your customer journey, unless it makes it shorter, less expensive, or more convenient, that technology is useless.
Yeah. So what about Hans? What about on the wholesale side?
I think maybe on a similar concept, in the EU we've launched open banking, and in the UK is very advanced as well. And I think it follows the same concept. Maybe not a pure technology drive, it means around APIs and exchanging data, but I think building a regulatory framework for open banking that really pushes the banks into paying attention, working with fintechs, making things a lot better. I think that's where we see a lot of value. And at the moment, I think in the EU is a very exciting place. And the PSD2, and the UK is taking sort of the lead in that by forcing all the retail banks to push open banking apps. There's new apps out there available which are a lot better than your average banking app. So I think that's really exciting, maybe not purely on the tech front of view, but I think the force of like a regulator driving innovation, new concept as well. But I think that's a very exciting prospect, and we see a lot of activity around there. And it starts at the retail level, but then it can go further out into SMEs and into the large corporate space, how they operate with technology, how they operate with banks. I think that's a real big area to watch, where we can make a lot of improvements, and like I say, it's all about the customer journey, helping them along, making things better and easier through that kind of concept. I think that's really exciting.
Yeah, it's interesting. At the Paris FinTech Forum last week, the consensus we came to on the open banking stuff was that Apple, Google, Facebook, these are the players who probably will win most out of open banking, because as they start to develop AIs that will be in your daily life, access to banking data is going to give them an edge in terms of surfacing those experiences. So I think the banks are going to be under pressure to form these strategic partnerships pretty quickly. Umair, what about yourself?
So I think there are a couple of things. One, I think coming to the KYC issue that a lot of people refer to, and it just gets me thinking that why can a bank account not be opened when the government is first issuing an ID card to a citizen of theirs?
That's how India does it now, right?
So why would you, because the government is the one who gives the KYC document, so why can't a bank account not be open? And secondly, when it comes to this credit decisioning, etc., a lot of that is based on what the consumer tells you and what patterns you see. But at the same time, there's a lot of data held by the government on people, especially if you're tax paying or some sort of VAT or some sort of tax payments. Why can't that data be used to really better profile a customer and help some of these institutions with the decisioning? Now, coming to the fintechs, I think what excites me is that we're seeing the first early waves of fintechs right now. I think they're going to be a bit like the CD drive. We're going to very soon see the DVD, but I don't think we're seeing the USB sticks just yet. I think they same like the .com era, when the first email was Hotmail, the first search engine was Yahoo, but the dominant one today aren't those. So I think the same thing will happen in the fintech, that you're starting to see these early players come in, but I think the better parts are yet to come, and I think that's what gets me really excited, thinking about what's more to come.
I think I'll just build on a few things which we've heard. I mean, certainly on the AI piece. So what excites me personally, and what excites us most, and we've actually gone on the record again recently in the Future Investment Initiative that was held a few months back in Saudi, which is saying data is the new oil. I mean, we made that statement. And data is hopefully the backbone that underpins any AI initiative that you come up with, because there has to be some data backing. So for us, while we are a payments company, we're a technology company, but with over 2 billion consumers worldwide, the amount of data that is generated is just huge. Now, how do we apply it? How do you use it? Now, data, any application of data that actually enables any of the relevant economic segments to enhance their economic standing, that's what personally excites me and excites us. What do I mean by that? We are enabling small farmers in sub-Saharan Africa to digitize the whole of supply chain of payments, where they buy from and where they sell to, right? That's an initiative which we launched last year called Takuza. Why is that important? Because all of a sudden now, there is transparent, auditable cash flows that can be used to generate a credit score to give them small micro ticket size type of lending, so they can actually expand their farm, right? Similarly with small and medium-sized enterprise, not just the micro, in different economic segments. Similarly at the level of the individual, when we talked about unbanked or underserved, the unbanked or underserved, we sometimes hear the word, he's not bankable or she's not bankable. And what that normally means is that they're not lendable to. And they're not lendable to not because of the smallness of their income, but because of the lack of data about what they do. What's their disposable income? What's their lifestyle?
Right, so the cost of acquiring that data is more than the margin on the product.
Exactly. So anything that actually can help generate data, analyze the data, and more importantly, apply the data to help the relevant economic customer segments enhance their economic standing and their lifestyle, that's something that personally excites us and excites me, and we're doing a lot of work in that area.
That was a good piece of data from Jack Ma. Remember what he said he needed to get 10,000 new customers? He said 2 servers.
Correct.
He didn't need all these branches and networks and so forth. This was his key message. So, these guys think about this differently. I was surprised none of you guys mentioned blockchain.
I've actually, we've created a company of blockchain in Pakistan. and we've now put university degrees on blockchain, so not a financial application, it's a certified application. What we're looking actually, very honestly, we've had a challenge with banks in terms of embracing the blockchain technology beyond trade. And even the trade transactions done have been a single transaction. Most banks have not done multiple trade transactions to test blockchain. Actually, I think that, the best case of blockchain, in my view, is for Sharia compliant lending or Islamic banking. Because
That's interesting.
that requires a contract at every stage and needs time stamping. And what typically happens is the salesperson does that entire transaction. If you take auto finance, for example, from each of the steps, they do it together, then they time stamp it. Sharia advisor comes in, takes a look, finds it out of sequence, imposes a fine, goes to charity. So if you put that whole process on blockchain, it's something that lends itself very well. So we've got two POCs.
Plus you get the proofs, right?
Yeah.
That you
So at every step, you can actually definitively create that contract, timestamp it, show the value exchange. So in my view, that's one of the spaces where blockchain probably will be adapted, and it has huge implications for the Middle East, given the Sharia compliant lending that takes place. On the conventional side, I haven't actually seen that many banks take this as a regular practice and demonstrate multiple transactions. KYC, for example, can be used on blockchain quite easily, but banks are still slow in actually adopting the technology.
So I don't know whether you saw the announcement from the World Economic Forum 2 weeks ago, but Canada and a number of other governments have announced a digital identity program to essentially replace passports on the blockchain. So this is pretty exciting. But this does lead us to this question. If you're going to have blockchains that are storing identity data and so forth, what about data residency? I know Singapore is investing strongly in data residency structures to support this, but where do you get the data and who owns the data? Because today, banks do all the KYC, they have all this data themselves, but increasingly as we look at other data sources to support things like financial inclusion, we're going to go outside the data collection systems of the bank. And so who owns that data?
Yeah, it's a tricky question. I think with blockchain, we could look at integrating it. I think some of the problems we have with blockchain still is either getting the data or controlling the blockchain, as it were. So we still have enterprise controls or like private blockchains where you control the parties on there and you can do things. So if you take it back to KYC or other things like that, you have to probably agree a KYC standard. All the banks are happy to upload their KYC to one central blockchain, and then you can pull from that really quickly. It's an awesome concept. I think getting to that in practice is a little bit difficult. So at the moment, we have a proof of concept running where we can exchange data with two banks through a blockchain if a payment is stuck. So we're starting to do these things, but I think you still have a problem of having a large public blockchain and controlling access and data. I think that's a big stumbling block of taking blockchain to a much larger domain.
Do you guys think banks will be in the identity business in 10 or 20 years' time? Or it will be a service layer that's out there?
Look, I mean, I think the identity as a means to authenticating the individual with whom there is some form of relationship, contractual or otherwise, will remain important. Because the transparency of certain type of transactions is important, right? Now, I think probably the more relevant question is that how is identity necessarily going to be authenticated? Is it going to be through the usual 20-page document, ID, card, and wet signature? Or is it going to be through biometrics?
Biometrics, yeah. Or heuristics.
Exactly.
Behavior, yeah.
So my firm belief is that organizations will remain in that business, but I think the form factor will become faster, cheaper, more effective, and more reliable in the form of biometrics. Now, biometrics is traditionally your thumbprint, but it's now your facial recognition. Biometrics are the way you walk. Biometrics is your heartbeat. Biometrics is a variety of things that are being developed now, and we're developing many of them to actually say, quick authentication of the veracity of, who you are and where you've been or what you've done, right? So I think that piece is going to remain important. The earlier point, and I'll just say maybe one sentence on it, the blockchain, related to blockchain. I think it's important when we're talking about blockchain is distributed ledger technology and so on, and to say privacy and who owns the data, to differentiate between personal data, financial data, and then demographic data, and transaction level data, right? I think personal data, by definition, I mean, the ownership is clear, right?
Sure.
Personal stroke demographic. Transaction data, less so, because it's there, it's public domain information, right? And so I think that distinction needs to happen to be able to answer the question, but it's not a one-size-fits-all. Yeah.
Okay, so let me finish up with this question for you guys, because I think it's be a nice way to round out the discussion. So we see a lot of these technologies, blockchain, AI, and so forth. We see these fintechs emerging, taking market share in specific areas. Let me ask you this question. Maybe we start with yourself. Is what do you think will be the most impactful technologies? You said AI, but more importantly, how are those technologies going to impact, employment in financial services, organization structure in incumbents?
Yeah. I think these technologies on their own are great, but I still think they're all going to go through their evolutionary stages. Especially, I think blockchain. I mean, the concept is great, but just to carry on with it, the infrastructure cost and the associated cost of running the blockchain and the limitations of how much data you can store and how flexible it is, I think they're quite prohibitive. I think certainly on the artificial intelligence side, I'd agree with Nadeem, but I think we as humans are also going to be grappling of how best to bring artificial intelligence into our lives to better service ourselves. I think, the question that you had about banks, I think in 10, 20 years, I think banks will disappear. I think banking will, what's going to come to the forefront. I think it'll be less about the identity, but more about the transactions. But I think the technology which is here today, I think artificial intelligence is going to be the way forward. But again, I think it's still early days. There is going to be a lot more evolution for that to happen. I think it's still early days.
If I could,
you're going to be out of a job, Hans.
Yeah, change slightly the issue. The buzzword right now is a digital bank.
Password's crazy,
Okay,
right?
Digital bank. What is a digital bank? And how does a conventional bank, become a digital bank? For me, unless you're changing the customer journey, having a sexy app up front which allows the customer to access your account, but having the same back office which takes, hours or days to transact that particular transaction, there's nothing magical about it. So, what does digital bank mean? Is it just, an app which is giving you a payment access? Or is it the use of AI or machine learning that's giving you nano credit, credit decisioning within 10 minutes, push to a mobile account and cash in your hand through a branchless banking agent, under a 10-minute time frame? Or, is it allowing you to create, institutional ROSCAs, which are allowing AI to actually look at the people who want to create the savings club and bringing that savings into the banking channel, which it doesn't exist right now because this is the informal saving mechanism, mostly in development countries where they're not even using bank accounts. So,
Nadeem, let me ask you a pointed question on this. In 10 years, do we need bank tellers to open bank accounts?
Sorry?
Do we need bank tellers to open bank accounts in 10 years?
I don't think you need bank tellers right now to open a bank account, right. Okay? But the reality is, until regulation catches up with this, then the banks will not be able to move away from tellers. I mean, if somebody tells me a digital bank is...
So the only limitation right now is not a technology one, it's a regulatory.
It's a regulation has a major role to play, and obviously the current ecosystem are all the citizens in that country biometrically verified, for example, helps the central bank actually move that goalpost. Can you get the telcos to cough up the data which is linking the mobile phone with a national identity card, and you have a real-time ability to check that, allows you to do lower KYC. So it's the ecosystem and the central bank's ability to look at that ecosystem and provide regulations which allows banks or fintechs to move, for financial inclusion purposes.
So, Brett, if I could just build on Nadeem's thing, I think one of the challenges is global regulations. Today, each country has their own regulations, so when people are mobile, people are moving around, it's so prohibitive, and I think this is what's going to hold back fintech evolution, is these different 140, 50, 60 countries, each having their own sets of regulations. I think we need a way in which banking can move across borders without having to worry about the friction that regulations create.
So this is a good question from the audience, and this is to Nadeem. Do you think it's possible for bank regulators to remain ahead of the fintech curve?
Absolutely. I mean, it's the vision that the central bank has. It's the sandbox environment they create. It's the working groups they create. The banking regulators are no different from you and I. You've got to just get immersed, and you need to have that passion and belief that your mandate is not just monitoring banks, it's also financial inclusion and bringing the unbanked into the banking world. So I've seen banking regulators being ahead of us, and being as savvy and understanding all the technologies changes that are taking place and creating regulations to do that.
So we're talking about reg tech as this class of technology, fintech technology we apply specific to regulation, but how do regulators become technology companies? That's a question for another time. But I'd like to thank the panel today. I think we've had a very interesting discussion. Please join me in thanking Khalid, Nadeem, Hans, and Omer for participating in this discussion.